There is a number sitting inside your brokerage account right now that you have almost certainly never looked for. It is not your balance. It is not your return rate. It is the figure that determines exactly how much of your money the government is legally required to give back if Schwab, Fidelity, or Vanguard ceased to exist tomorrow. Those three firms together hold more than $20 trillion in client assets, spread across tens of millions of American households. The assumption built into almost every one of those accounts is that the money is safe. Not safe the way a savings account is safe. Safe in the way that institutions this established simply do not fail. That assumption is not wrong, until it is. What this video is not about is whether any of these firms will collapse. The historical probability of that is very low. What it is about is the one number that decides exactly what you get back, how long it takes to arrive, and why a portion of your portfolio may sit completely outside the protection you believe you have. To understand what that number actually means, it helps to start not with Schwab or Fidelity or Vanguard, but with a firm you have almost certainly never heard of, because it no longer exists. MF Global Holdings was, in 2011, one of the largest futures brokers in the United States. It was publicly traded on the New York Stock Exchange. It was regulated by both the Commodity Futures Trading Commission and the Financial Industry Regulatory Authority. Its credit ratings were investment grade. Its CEO was John Corzine, a former chairman of Goldman Sachs, a former United States senator, and a former governor of New Jersey. If you were building a list of firms whose stability you would never think to question, MF Global belonged on that list. On October 31, 2011, MF Global filed for Chapter 11 bankruptcy protection. It was, at the time, the 8th largest bankruptcy filing in United States history. Within days of that filing, something emerged that regulators had not expected. Investigators trying to account for the firm's assets discovered that approximately $1.6 billion in client funds, money that federal law required to be held in segregated accounts completely separate from the firm's own capital, was missing. Not delayed in settlement. Not frozen pending review. Missing. What regulators found was not an accounting error. What they found was that MF Global had, over a period of months, transferred client funds into its own proprietary accounts to cover margin calls on leveraged bets it had placed on European sovereign debt. The firm had wagered that bonds issued by Italy, Spain, Portugal, Ireland, and Belgium would recover from the crisis then spreading across the Eurozone. When those positions moved against it, the firm needed cash, and it reached into accounts that were not its to touch. Here is the question that the investigation had to answer. Did anyone inside MF Global know this was happening? The answer was documented in thousands of internal emails and regulatory filings. Internal compliance officers had flagged the transfers. Risk reports had identified the exposure. A senior official was later identified in Senate testimony as having direct knowledge of the movements. The warnings existed. They did not stop what happened. The clients caught in that collapse were not retail investors who had ignored fine print. The MF Global customer base included professional commodity traders, agricultural companies using futures contracts to hedge crop prices, small banks managing their own exposure, and institutional accounts that had completed every standard due diligence check available to them. They had verified the firm's regulatory standing. They had reviewed its credit ratings. None of that protected them. When the bankruptcy estate was settled, a process that involved the CFTC, the FBI, and years of federal proceedings, clients ultimately recovered approximately 93 cents on the dollar. That figure is commonly cited as evidence that the system functioned. It is worth examining what it does not say. 93 cents on the dollar meant that for every $100,000 held at MF Global, a client recovered $93,000. $7,000 was gone permanently. More significantly, that recovery did not arrive in weeks. It came through a series of court-ordered distributions that ran from 2012 through 2014. Clients who needed liquidity during that period, to meet margin calls of their own, to pay obligations that could not wait for a bankruptcy timeline, to fund withdrawals from accounts they had believed were accessible, received nothing while the proceedings ran their course. Now here is the structural detail that makes everything that follows in this video relevant to your actual account. MF Global was a futures broker operating under the jurisdiction of the CFTC and the National Futures Association. The firms where most American retail investors hold their savings, Schwab, Fidelity, Vanguard, are securities broker-dealers regulated by the SEC and covered by an entirely different protection mechanism. That mechanism has a name. It is called the Securities Investor Protection Corporation. And the gap between what most people believe it does and what it actually does is the subject of the next section. The Securities Investor Protection Corporation was created by an act of Congress in 1970, and its origin clarifies exactly what it was designed to do and what it was not. In the late 1960s, the U.S. securities industry went through what regulators called the paperwork crisis. Trading volumes had outpaced back-office systems, brokerage firms were drowning in unprocessed records, and between 1969 and 1971, more than 100 broker-dealers failed or were forced into emergency mergers. Retail investors caught in those failures lost securities they had legitimately purchased, not because the market moved against them, but because their broker's administrative infrastructure had collapsed. Congress created SIPC specifically to address that problem, the operational failure of broker-dealers and the resulting loss of customer property. SIPC is not a government agency. It is a nonprofit membership corporation funded by assessments on its member broker-dealers, not by taxpayer money. Every licensed broker-dealer in the United States, including Charles Schwab, Fidelity Brokerage Services, and the broker-dealer subsidiaries through which Vanguard executes trades, is required by federal law to be a SIPC member. The fund SIPC maintains for potential liquidations currently holds approximately $4.3 billion. Here is the figure everything else in this video turns on. SIPC protection covers up to $500,000 per customer per brokerage firm. Within that limit, a maximum of $250,000 applies to cash claims. If you hold $400,000 in equities and $80,000 in cash at Schwab, and Schwab entered a SIPC liquidation tomorrow, the corporation would work to return those assets up to the statutory limits. That protection is real and legally enforceable. In the more than 330 broker-dealer liquidations SIPC has overseen since 1970, it has returned assets to customers in the large majority of cases. The question is where the protection stops. The $500,000 figure is not a cap on account size. It is a cap on coverage. An investor holding $1 million at a single brokerage has $500,000 covered and $500,000 that is not. The uncovered portion becomes an unsecured creditor claim against the broker-dealer's bankruptcy estate, joining a queue behind secured creditors and administrative costs. What that claim eventually recovers depends entirely on what the estate has left to distribute, and the timeline is set not by the investor but by the court. Bankruptcy proceedings of any complexity routinely extend over months or years, and during that window, the assets in dispute are not accessible. For an investor counting on those funds for retirement withdrawals or tax obligations on a fixed deadline, that is not an administrative detail. It is a crisis. Here is the structural detail most account holders have never checked. SIPC coverage applies per customer per brokerage firm, not per account. An investor holding a taxable account, a traditional IRA, and a Roth IRA at Fidelity might assume the $500,000 limit applies to each account separately, producing $1.5 million in effective coverage. That is not how the rules operate. SIPC aggregates accounts held in the same legal capacity at the same firm. Two traditional IRAs at the same broker-dealer count as one pool for coverage purposes, not two. Individual accounts in the same name are similarly combined. The SIPC website itself directs investors to review their specific account documentation because a single general rule does not apply cleanly across all account structures. The practical result? An investor who believes they have $1.5 million in protection distributed across 3 accounts may have considerably less than that assumption implies. The question that stays open entering the next section: If $500,000 per customer is the statutory ceiling, and the fund behind that ceiling holds approximately $4.3 billion to cover a system carrying more than $20 trillion in total client assets, what happens to that arithmetic when the failure scenario involves more than one firm at a time? The $500,000 limit is the number most investors know, or at least the number most investors cite when the question of brokerage safety comes up. It functions as a mental shorthand for protection, a threshold beneath which the assumption of safety feels justified. What most accounts of SIPC coverage stop before reaching is the list of what falls outside it. That list is longer than most investors expect, and some of what it excludes is common enough to appear in ordinary accounts held by ordinary retirement savers today. Start with the most fundamental exclusion. SIPC was created to protect customers from the operational failure of a broker-dealer, the loss of property caused by a firm's inability to maintain proper records, execute transfers, or segregate client assets from its own capital. It was not created to protect investors from market risk. If you hold $500,000 in equities at a covered brokerage, and that brokerage fails while those equities have dropped 40% in value, SIPC works to return your securities, not the value those securities had before the decline. The protection is against the administrative failure of the firm, not against the market conditions in which that failure occurs. That distinction matters more in a scenario involving a large brokerage failure because such events rarely happen in calm markets. The conditions most likely to threaten a major broker-dealer, severe credit stress, rapid asset devaluation, a crisis in the collateral markets, are precisely the conditions most likely to have already reduced the value of the assets SIPC would work to return. Beyond market losses, certain categories of assets are explicitly excluded from SIPC coverage, regardless of account size. Commodity futures contracts, the instruments at the center of the MF global collapse, are not covered by SIPC because they fall under CFTC jurisdiction rather than SEC jurisdiction. If you hold currency futures, agricultural futures, or energy futures through a securities brokerage subsidiary that also clears commodities positions, those contracts sit outside SIPC's mandate. Certain fixed annuities, interests in limited partnerships, and some categories of foreign currency transactions do not qualify as securities under the Securities Investor Protection Act and therefore do not qualify for coverage. This matters because brokerage platforms today offer a substantially wider range of products than they did in 1970, and not all of them fall within the statutory definition that determines protection. There is a second gap that affects investors who have enrolled in securities lending programs, a feature that several major brokerages now offer as a way to generate incremental income on idle holdings. When you lend your securities through a brokerage-managed lending program, the legal title to those securities temporarily transfers to the borrower. If the brokerage fails during a period when your securities are on loan, the status of those positions under a SIPC liquidation is not straightforward. The specific answer depends on the terms of the lending agreement and the structure of collateral arrangements, terms disclosed in documentation most participants in those programs have never read in full. Here is the exclusion, with the most direct relevance to the accounts many investors have built for retirement. SIPC coverage does not guarantee protection for uninvested cash held in money market sweep funds. If your brokerage account automatically parks uninvested cash into a money market mutual fund, a standard feature across Schwab, Fidelity, and Vanguard platforms, the treatment of that cash under a SIPC liquidation depends on the specific structure of the sweep arrangement. Cash moved into a bank sweep program, where the brokerage deposits your uninvested cash overnight into FDIC-insured accounts, may qualify for FDIC coverage up to $250,000. But through the bank program, not through SIPC. Cash held in a money market mutual fund is treated differently because the value of those fund shares is not guaranteed by SIPC against a decline in net asset value. An investor who assumes their cash equivalent holdings are covered dollar for dollar may be operating under a framework that does not match their account's actual structure. Checking which arrangement your brokerage uses requires reading one section of your account agreement. The percentage of investors who have done this is almost certainly very small. The open question the next section addresses: if this is the architecture that exists, what does the math actually look like when the failure scenario scales beyond a single firm? The question left open at the end of the last section was about scale. Specifically, what the math looks like when the failure scenario involves more than one firm. Before reaching that question, it is worth correcting the frame most people bring to a discussion of brokerage risk. The instinctive fear when this topic comes up is total loss, the scenario in which a firm fails and investors receive nothing back. That outcome, while not impossible, is not the central failure mode the current architecture leaves unaddressed. In the large majority of the 330-plus liquidations SIPC has administered since 1970, customers within the statutory coverage limits recovered their covered assets. The catastrophic scenario most people imagine is not the most probable consequence of a major broker-dealer failure. The failure mode that actually remains exposed is subtler and harder to prepare for, precisely because it does not produce the visible, dramatic outcome that triggers emergency legislation or congressional action. It is a problem of time, of statutory thresholds lower than most investors realize, and of what happens when a mechanism built for isolated sequential failures is confronted with a problem of an entirely different order of magnitude. Here is the number that recontextualizes everything the preceding sections have established. The SIPC fund currently holds approximately $4.3 billion. Schwab, Fidelity, and Vanguard together custody more than $20 trillion in client assets, a figure drawn from regulatory filings, not rounded for rhetorical effect. The ratio of the reserve fund to the asset pool it theoretically backstops is roughly $1 of coverage for every $5,000 held in the system. SIPC was built to manage individual operational failures, one firm at a time, at the scale of broker-dealers common in 1970. It has never been tested against the simultaneous distress of institutions operating at the scale those three firms now represent. The statute does include a contingency provision. SIPC can borrow up to $2.5 billion from the U.S. Treasury through the SEC if the fund is depleted during a liquidation. That brings the total theoretical ceiling to approximately $6.8 billion, against a market carrying more than $20 trillion in retail assets. The borrowing authority was set in 1970. It has not been revised upward since. The legislative record answers the question this raises directly. Congress examined SIPC's capitalization framework most substantively in the period following the MF Global collapse, when Senate hearings placed the gap between the fund's resources and the industry's actual scale into the formal record. The proposals that followed did not produce a statutory increase to the borrowing ceiling and did not alter the fund's required minimum balance. The framework governing the SIPC fund today is structurally the same document with the same financial parameters as the one enacted 5 decades ago, applied to an industry that has grown by orders of magnitude in the intervening period. The regulatory logic that accounts for the absence of revision holds that firms the size of Schwab or Fidelity would never enter a disorderly SIPC liquidation, that their systemic importance would generate a government-coordinated resolution process before that scenario unfolded, consistent with the interventions that characterized 2008. That reasoning has historical precedent behind it. It is not a statutory commitment, it is not enforceable in court, and it does not appear in the account agreement you signed when you opened your brokerage account. What that unwritten assumption leaves exposed connects directly to the MF Global case established in Block 2. That firm was not expected to fail. It was regulated, rated investment grade, and actively supervised by 2 federal agencies. Its resolution ultimately returned most client funds, but the process ran for years, not weeks, and the investors who needed access to those funds during the proceedings had no mechanism to obtain them while the court process determined the outcome. Scale that timeline to a firm holding trillions rather than billions, or to more than one firm under simultaneous stress, and the central risk is no longer about the percentage of assets eventually recovered. It is about whether the recovery arrives on a schedule that matches the one a retirement plan was built to depend on. The next section examines what the documented record of completed SIPC liquidations actually shows about how long that timeline runs, and what it has meant in practice for investors who could not wait for a federal court to set the pace. The timeline question the last section left open is not a technical detail. It is the central variable that determines whether a protection mechanism functions at the moment an investor needs it, or merely functions eventually, on a schedule set by a federal bankruptcy court rather than by the retirement plan those assets were built to support. The documented record of completed SIPC liquidations provides the most direct evidence available on how long that schedule actually runs and what the variation in that timeline has meant for investors caught inside those proceedings. The most straightforward cases in SIPC's history have proceeded reasonably close to as designed. Broker-dealers that failed with intact records, cleanly segregated client assets, and no evidence of fraud or misappropriation saw their customer accounts transferred to solvent-receiving brokerages within weeks of the initial filing. Customers within the statutory coverage limits experienced limited interruption of access to their holdings. Those cases represent the documented majority of the 330-plus proceedings SIPC has administered since its founding, and they form the empirical foundation most defenders of the framework cite when its adequacy is questioned. The architecture, operating inside its design parameters, an isolated operational failure at a single firm with properly maintained records, functions reasonably close to as intended. The cases that exceed those parameters produce different outcomes. The liquidation of Lehman Brothers Incorporated, the registered broker-dealer subsidiary, legally distinct from the Lehman Brothers Holdings parent company's separate Chapter 11 proceedings, was initiated in September 2008 and became the most complex securities liquidation in SIPC's history. Lehman's broker-dealer held customer positions across dozens of account categories, including structured credit products, derivatives contracts, and securities held through foreign subsidiaries that required separate legal proceedings in multiple jurisdictions before those positions could be addressed within the U.S. liquidation framework. Disputes over the classification of specific asset types required federal court rulings before distributions in those categories could proceed. Customers holding standard equity and bond positions were transferred to Barclays Capital under an expedited weekend transaction, an outcome that was possible because a willing strategic acquirer materialized under extreme time pressure. Customers holding positions in contested categories waited on a court-imposed distribution timeline that extended years past the initial filing. The differential outcome between those two groups had almost nothing to do with the statutory coverage limits each account carried. It depended on whether a qualified buyer appeared in a 72-hour window. The Stanford Financial Group liquidation, initiated in 2009 following the SEC's fraud case against Alan Stanford's offshore certificate of deposit program, raised a different structural question with equally damaging results for affected investors. SIPC's legal determination, contested through federal litigation at the district and appellate levels, was that the Stanford certificates of deposit did not qualify as securities under the statutory definition governing SIPC's coverage mandate. That definitional dispute ran through federal courts for more than a decade before a resolution framework was established. Throughout those proceedings, investors could not access the contested funds while the jurisdictional question remained before the courts, regardless of how the eventual ruling would position their individual claims relative to the coverage limits. The case did not turn on the size of the reserve fund or the efficiency of SIPC's administrative process. It turned on a definitional boundary the statute had not been updated to address, applied to an instrument that post-dated the legislative language used to define the scope of protection. That boundary question has not been resolved by updated legislation for the categories of financial products introduced to retail brokerage platforms in the decades since. Those proceedings form the evidentiary record the legislative process has reviewed repeatedly without producing structural revision to the core framework. Following MF Global, Stanford, and the 2008 crisis liquidations, the Securities and Exchange Commission submitted formal recommendations on SIPC reform to Congress. Congressional hearings produced testimony from regulators, legal scholars, and investor advocates across multiple sessions. The Government Accountability Office published structured analyses identifying specific gaps in the framework's design and capitalization. The fund's borrowing authority from the U.S. Treasury remains at $2.5 billion, the figure set by statute in 1970. The coverage ceiling was last adjusted in 1980. The architecture that produced the documented outcomes in each of these proceedings is the operative structure today, applied to an industry whose asset base its designers did not anticipate. What no completed liquidation has yet been required to answer is what the framework produces when the failure involves not a single isolated firm, but institutions whose combined custodied assets dwarf every reserve and borrowing facility the current structure holds. That is what the next section addresses directly. The MF Global case was loaded into this analysis as a structural detail that would land with full force at this exact point. Recall what the investigation documented. The transfers of client funds into proprietary accounts were not invisible to MF Global's compliance infrastructure. Officers had flagged the movements. Risk reports had identified the European sovereign debt exposure. A senior executive was documented in Senate testimony as having direct knowledge while the transfers occurred. The legal requirements governing client asset segregation were formally in place, actively monitored, and applied right up until they were not. What collapsed was not an absence of rules. What collapsed were the conditions that make rules enforceable in practice: the capital buffers, the leverage ratios, the timeline for correction. That is the documented sequence across every major broker-dealer failure. Not a gap in the rulebook, but a deterioration that outpaces the available response time. Scale that sequence to the institutions this video has been examining. Schwab, Fidelity, and Vanguard are not structurally comparable to MF Global. A direct comparison is misleading in most material dimensions. The relevant question is not whether they resemble MF Global in architecture. It is whether the protection framework designed to backstop their investors was built for a failure at their current scale. The SIPC fund holds approximately $4.3 billion. Its Treasury borrowing authority brings the ceiling to approximately $6.8 billion. Schwab custodies approximately $9.4 trillion in client assets per its most recent regulatory filing. Fidelity reports approximately $12 trillion across its combined platform. Vanguard manages approximately $9.3 trillion in fund assets. The three institutions combined represent a concentration of retail investment assets without precedent in the history of the statute that governs their protection. A number operating inside a protection framework whose financial capacity is measured in single-digit billions. A simultaneous liquidity event affecting more than one of these institutions would generate customer claims exceeding the SIPC reserve and its full Treasury borrowing capacity by a margin that is not close. The assumption that resolves this gap in the legislative record is that government intervention would occur before a SIPC liquidation became necessary, consistent with the 2008 emergency actions in Bear Stearns and AIG. What those precedents do not establish is a legal obligation. No statute requires the Treasury or the Federal Reserve to intervene in a broker-dealer failure at any specific asset threshold or within any specific timeline. The commitment that bridges $6.8 billion in documented resources and $31 trillion in custodied retail assets is institutional and political, not contractual, not codified in the Securities Investor Protection Act, and not present in the account documentation signed by a single investor holding assets at these three firms today. That gap is not an oversight or a drafting error. It is a deliberate legislative assumption that the scale of these institutions makes disorderly SIPC liquidation politically untenable. Whether that assumption holds under conditions not yet tested is not a question the current statute answers. That is what the MF Global detail was loading toward, not the dollar figure, not the proceedings timeline. The structural payload is this. At MF Global, every protection designed to stand between investor assets and their loss performed as designed until the moment it did not. And the SIPC recovery that followed ran on a timeline set by federal courts over years rather than weeks, during which investors who needed those funds had no mechanism to access them. Apply that documented timeline to institutions operating at a scale 1,000 times larger, and the central risk shifts. It is no longer about the percentage of assets eventually recovered. It is about whether that recovery arrives on the schedule a retirement plan was built to depend on. The next section establishes what an investor can actually verify and do about this today. The answer to the question this video opened with is not the catastrophic one most people imagined when they first read the title. If Schwab, Fidelity, or Vanguard collapse tomorrow, the most probable outcome for an investor within the $500,000 coverage ceiling, holding standard equities, bonds, and mutual funds in a standard account structure, is eventual recovery of the covered assets. The documented record of more than 330 SIPC liquidations supports that conclusion. The system, operating inside its design parameters, returns covered property to covered customers. That is the first honest answer this video is obligated to deliver, and withholding it in favor of a purely alarming conclusion would be the kind of framing this channel does not produce. The second honest answer is the one that required the preceding 7 sections to establish properly. The protection is real and legally enforceable, and it is specific in ways most investors holding accounts at these firms have never verified against their own account structure. $500,000 per customer per brokerage firm is the statutory ceiling, not per account, not per account category, and not automatically applicable to every instrument a modern brokerage platform makes available. The timeline for asset recovery and complex liquidations is governed by federal court proceedings, not by investor need. And the documented timeline in the most complex cases runs in years, not weeks. The fund behind the protection holds approximately $4.3 billion, with a Treasury borrowing facility that raises the ceiling to approximately $6.8 billion, against a system carrying more than $30 trillion in retail assets across the 3 firms this video has examined. The assumption that resolves that arithmetic gap is not a legal commitment. It is an institutional and political expectation that the systemic importance of institutions at this scale would generate a government-coordinated intervention before a SIPC liquidation became necessary. That expectation is not unreasonable. It has precedent behind it in the emergency actions of 2008. It is also not written into any statute, not enforceable in any court, and not present in the account agreement that governs the relationship between those institutions and the investors whose assets they custody. What that means in practical terms for an investor reviewing their accounts after watching this video resolves into 3 specific things worth checking before closing this tab. The first is whether total holdings at any single brokerage firm exceed $500,000. And if they do, whether the amount above that ceiling is addressed by the brokerage's excess SIPC insurance, purchased privately through providers such as Lloyd's of London and extended beyond the statutory limit. Schwab, Fidelity, and Vanguard each carry versions of that excess coverage, with per-customer ceilings that vary by firm and account type. The specific terms are disclosed in each firm's account documentation, and reading that section takes approximately 4 minutes. The second thing worth verifying is how uninvested cash in your account is handled. A bank sweep arrangement, where the brokerage deposits idle cash overnight into FDIC-insured bank accounts, produces different coverage characteristics than a money market mutual fund sweep, where the dollar-for-dollar guarantee most investors assume does not apply in the same form. Your brokerage's default sweep arrangement is identifiable in your account settings without a phone call or an advisor appointment. The third is account aggregation, specifically whether multiple accounts held at the same firm in the same legal capacity are being treated as separate coverage pools in your own mental accounting, when SIPC rules combine them into a single pool for the purpose of applying the statutory limit. None of these checks require a financial advisor or specialized knowledge. They require reading one section of documentation each of these firms publishes and is legally required to maintain in accessible form. The number this video asked you to locate at the beginning, the one that determines how much of your money the system is legally required to return and on what timeline, is in that documentation. It is not your portfolio balance. It is not your rate of return. It is the documented, legally enforceable ceiling on coverage, the specific instruments it applies to, and the conditions under which it does not apply at all, The gap between that number and the assumption most investors carry is not evidence that these institutions are unsafe. It is evidence that the framework is specific, that specificity is consequential at the scale of retirement savings, and that the investors best positioned to navigate a stress scenario are the ones who understood the architecture before they needed to rely on it. If you have made it this far with me, I want to invite you to subscribe to our channel and follow along every day. Share this video with 5 people who hold investment accounts and have never asked this question. It is exactly the kind of question most financial content is designed to avoid. Leave a comment with what you found when you checked your own account, or with the topic you want this channel to examine next.